but they're just not venture backable.
Yeah, most companies aren't venture scale. I mean, if you look at the number of companies that go on to achieve venture success, it's a tiny, tiny, tiny percentage of all the companies in the world. It just happens to be what startup culture got really excited by in the very beginning, and it's because the people who kind of laid the foundations of startup culture kind of came from that world. But there is a huge, incredible group of companies that are out in the world that have the potential to be 20, 30, $40 million companies that really may never go on to achieve a venture scale exit. I think the most exciting companies, however, I just think of them as TBD. I think there's also this tendency to think that you can predict, because of what a slide tells you about a company's unicorn potential, whether or not they will go on to become a unicorn. You and I know from a decade of experience working with companies that you can look like a unicorn on paper, but you may not have the execution or operational experience that turns you into that. But that doesn't mean that you won't be something awesome.
So give us a little bit of an introduction just for people who haven't had the pleasure of meeting you and what you're up to.
I am Melissa Withers. I am currently the founder and managing partner of RevUp Capital, which is a revenue-based investment fund for early-stage companies. But for a long time, prior to that, I was an early-stage equity investor. My partner and I have invested in total in about 130 companies over the last 7 years and have spent a lot of my most current life working with early-stage companies. I had a life before that, but it's irrelevant to the conversation. But a lot of my interests over the years in working with early stage companies is around the capital toolkit and innovating ways to help more companies grow. And while I loved being an equity investor, and I had an incredible experience early on working at kind of the dawn of the startup revolution, at the conclusion of that process, both my partner and I found ourselves increasingly frustrated by the limits of the tool. With equity, there's two ways to win. You either have an acquisition or an IPO. And I think that's awesome and really fun, and unicorn hunting is great, but I wanted to do something different, and I wanted to work with a broader spectrum of companies, and I wanted to be more exit agnostic. So I wanted to be able to work with a company before I was 100% sure on where their terminus might be. And so some years ago, my partner and I developed one of the world's first revenue-based models for investing into earlier stage companies, and I've been doing that now for the last several years.
That's awesome. So when you think about, and maybe when a founder is thinking about financing, maybe it's their first business, what is the kind of spectrum of financing that they should be thinking about from, equity and revenue, and kind of where do these things either slot in, and do they overlap, and how do they overlap?
I think we're living at a really exciting time where there are more capital tools available to entrepreneurs than ever before, certainly than back when you and I started our first companies in the Stone Ages. I think the challenge we have is that many of our startup and entrepreneurial education platforms are still relatively outdated in that we tend to still instruct founders just around all the rules of equity, how to talk to angels, how to raise a Series A, how to build a deck. But the reality is that in the capital market, there are a tremendous amount of tools that are now available to very early stage companies. And most founders have not had previous exposure to those tools and haven't had the education to use them responsibly. So when I think about companies, rather than be either or, I try to help them understand the different kinds of capital, what the pros and cons are, how they pattern match, and then try to help them figure out for their business, both short and long term, what kind of capital might be best for them. I mean, revenue-based funding has allowed me and many others now to invest into a really exciting spectrum of companies that when I really feel like it's been exit agnostic. Many of our companies have gone on to raise Series A and are on path to having an equity-enabled exit. And many of them are on path to become $30, $40 million companies. But I think the temptation here is to do this either-or thing, like equity bad, revenue good. And that's not true. There's a lot of purposes that equity has, particularly small e equity, that most companies can't get started without it. And when you don't have any revenue, then you're not really a good candidate for revenue-based funding.
And so kind of what is an ideal, and I'm sure it ranges, but kind of what are really good candidate type companies to explore revenue-based financing?
So there are many different kinds of revenue-based funding. There are revenue-based vehicles like mine that are purely revenue-based. That's all. We don't take any equity in the companies that we invest into currently. I reserve the right to change my model over time, as we have, right? It's one of the nice things about innovating. And then there are other models that are hybrid, that use a combination of equity and revenue, all to find creative ways to help companies that are worthy of funding get what they need to move forward. I forgot to answer the question you asked, and it leads into this, about overlapping. yes, all of these tools fit together. How they fit together, when you fit together, how you sequence them, that's part of the challenge of being a good capital operator. But there are no companies in the world that are equity only funded, right? Even the companies that we think of as venture darlings, if you got behind the scenes, they would, I can assure you, they're not using equity to fund short-term capital needs, for example. So now fast forwarding to ideal candidates. Given that there's a lot of diversity out there in tools, and I know a lot of the people that run those funds, and they're different than my fund, but really good at what they do. I think the most important thing, if you are evaluating revenue-based funding, is you have to understand the unit economics of your business in a way that that we might not have challenged you to do so in years past. If we thought you were just going to keep raising equity for forevermore, and you were just going to be valued around the other things that we value in businesses, you can kind of get away with that. If you're thinking about taking revenue-based funding, you really do need to understand the economic underpinnings of your business, because you're going to be committing some future percentage of your revenue back to your investor. So if you are really, really wrong about how that model works, those consequences could be quite dire. So I think what the kind of number one reality is, if you're thinking about revenue-based funding, is you really do need to understand your unit economics. You need to understand the patterns and how that paces out. You need to understand what your growth expectations are and how your costs and revenue will change over time, which is a really tall order when you're early.
And kind of functionally, operationally, does it end up being some form of percentage of your revenue that you're generating is servicing that financing?
Yeah, in general, it's really dangerous for me to generalize about deal structure, because there are literally hundreds of different kinds of revenue-based deals. But probably what the vast majority of us have in common is that there is an agreement in place called a revenue contract that stipulates some percentage of your revenue that you will return over some period of time till you get to a certain place. Most revenue deals have that as their sort of core, which is what differentiates them from equity and debt altogether.
And then on the spectrum of revenue-based financing, kind of when is an appropriate stage of revenue, or how much can a startup start thinking about that might be an option for them? Like, certainly not at the lemonade stand stage, or what do you think?
So again, herein lies the rub. You can pretty much find someone who will give you money almost at any time, whether or not it's good for you or not, right? So I think the first readiness is what we just talked about, which is you are in the market, you're selling, and your revenue generation has some kind of pattern. Again, I work with companies that are on this, my favorite part of the entrepreneurial journey is from about $1 million to $10 million. I love what comes before it, but I did that for a really long time, and I find this to be a really exciting place. And the revenue-based funding that I'm most familiar with, and the kind of revenue-based funding that my fund has, is most applicable for companies at the bottom of that curve. So you're somewhere between $600,000, $700,000, and maybe $2 million in revenue, and something is repeatable. And I think that's important when you think about revenue-based funding, is if everything is like for the first time, well, then what are you basing that on? And so when you're in a conversation with a revenue-based investor, how do they pattern that, right? So you need to have some repeatability, though in my companies, all of what we're trying to do to help them grow is figure out what other revenue-generating things we're going to layer on top of that. So again, I would say modestly stable. And then I think you have to have margins inside your business that can sustain that. So in many cases, a good revenue deal looks like a channel partnership. So in our case, maybe it's somewhere between 4 to 6% of revenue over some period of time. But the other thing is that most people don't realize with revenue-based funding is, what's the definition of revenue? Is it top-line revenue? Is it all revenue? Is it revenue minus COGS? What is it? And then there are other deals where, which I think can be really useful, where a revenue funder starts by taking a lot of equity and then you buy it back with revenue over time. And again, those deals often have slow ramp-ups where it's very little revenue in the beginning since you don't have a lot of revenue, but then it gets very big at the end. All kinds of things. So there's no one answer to that, except that you need to understand your unit economics. I think you need to have margins inside your business that can tolerate that. And you have to have good cash flow planning. You have to be able to know that if you're not returning until the end of the quarter, not to spend that money on other stuff.
Now, for founders that are selling equity, they're really selling a piece of their entire company. And like you said, it's typically until they're either acquired or they IPO. For revenue-based financing, kind of what's the end of the contract? Like if they want to go do something else, or how does that work?
Yeah, so again, there are so many good funders out there that have models that are different than mine. So with our revenue contract, when we make an investment into a company, it's to a fixed multiple. And it's however long that takes to achieve that fixed multiple based on the deal terms. And when it's over, right? And that's the end of it. When you hit your multiple, you're done. There are things that happen along the way that can be really exciting, and then there are terms inside of a deal that deal with that. So for example, if there's a change in ownership, then what happens to the contract? Does it persist? Does it change hands to the owners? Does it accelerate to the total value of the contract? And that's sort of where the devil is in the details, and you want to make sure if you're evaluating revenue-based funding that those are the kinds of questions you're asking, the sort of what ifs, right?
And I'm sure you talk to a lot of founders. Kind of what's a very common misconception around revenue-based financing that you hear?
There are a ton. Which is our fault, which is the investment community. It's partially my fault. Like, I'm paying the price for my days as an equity investor when I didn't pay attention to capital education, right? So I think the common misconception is that it's a silver bullet that you can use when you get rejected by equity. That is just not true, right? The equity alternatives are not there for you because you're not good enough to get equity. I think that's probably been the hardest misconception to get people to understand, that it's just different patterns that you're matching for. Now, we often do invest in companies that are in between seed and Series A, and the Series A is either not a good fit for them right now because they haven't quite achieved the milestones that would make them most eligible, or sometimes for founders that have gone to their rodeo and they don't want to go again, we're a way to sort of put that off. But more often than not, revenue funding is really focused on investing into things that have revenue generating potential in a pretty short time frame, and where equity is a better tool for more patient investments that take longer to yield. So they're really not either or. And so oftentimes people think, hey, I wanted to raise a seed round and no one would give me any money, so now I'm going to go raise revenue dollars. That is, and I meet a lot of founders who come to me with that, and I feel very disappointed in also rejecting them. But the problem that they have is that the business just doesn't have the traction or the predictability that either one of those funders want. And so that's probably the biggest misconception. And I think people often want to think it's debt. Like, they go right to debt and they think about interest rates and they think about cost of capital. They compare it to debt, which is, again, it's an apples and oranges comparison, because most revenue funding is unsecured. It's super high risk. It looks more like equity in that way, where debt is almost always secured by something. For early stage founders, it's usually your house or your personal assets, right? So I think it's, number one is thinking it's a silver bullet, and that it's what you do when you failed at raising equity. And then the second is that it's going to look like debt, so you should go and compare it to debt. And then you're going to be really disappointed when you see that the cost of capital is higher, because you're really getting a different kind of investment, and the comparisons just don't work that way. I think most founders just don't understand that it never ends, that there is no singular investment moment that ends the capitalization strategy. You know what I mean?
Yeah.
And I think a lot of times, for founders, they don't think ahead about how things are going to layer. So I think there's a lot of naivete about capital's real costs, and being able to read between the lines and look at the details and be ready to deal with those consequences, something like that.
Awesome.
Yeah.
Melissa, thank you so much for joining us. Fantastic to have you here.
Happy to be here.